short video, we will discuss bottom-up investing. We will define the bottom-up approach and then compare it to top-down investing. We will continue the discussion by describing some of the methods used in bottom-up investing, along with the pros and cons of this type of investment approach. Bottom-up investing is an investment style that focuses on individual company fundamentals. This approach focuses on the analysis of individual stocks. In the bottom-up investing approach, investors focus on a specific company rather than on an industry in which that company operates. The bottom-up approach assumes that an individual company can perform well even in an industry that is not performing well overall. This type of investing requires that an analyst understands every aspect of the company's operation and how they produce net income, which is profit. This includes becoming familiar with the company's products and services, its financial stability, and different research reports about the company. The style is different than the top-down approach, which would entail focusing on the fundamentals of an industry or an overall economy. Investors that use a top-down approach could look at economic data points like employment and growth, along with monetary policy to determine their views. They might also look at how a specific commodity such as oil would affect a driller, or how the change in a currency rate could affect an overall industry. Understanding management structure, the company's finances, and the products and services that they produce is tantamount to the bottom-up approach. Bottom-up investing can be thought of as the opposite of a top-down style, which relies heavily on economic data and trends. Analyzing financial statements is an important part of bottom-up investing. Investors will analyze cash flow, revenue, and expenses. Analysts should also be able to check a number of key ratios such as earnings per share to compare performance of a company over time and across competitors. Another characteristic of the bottom-up approach is the analysis of a company's products and services. If a company is working on increased lines of business and managing their businesses efficiently, this company would be a candidate for further research. Each company will require a different set of factors that an analyst can look at. For example, a manufacturing company would have a different required matrix or template when compared to a financial institution. A company that makes good decisions with their cash flow is well positioned for opportunities that come their way in the future. They are also better positioned for a rainy day. There are two distinct ways that companies can evaluate cash flow, and this is working capital and free cash flow to the firm. The former, working capital, is what is left over after current liabilities are subtracted from current assets. Insiders who trade, so company directors, is another good metrics to pay attention to when you are valuing a company in a bottom-up manner. If activity of trading from upper management is positive, where they're accumulating shares, this is something that is interesting and shows their devotion. If you're seeing selling by management, it's usually not a positive sign. What you really want to see is a high level of ownership from upper management. This means they have skin in the game and they feel as confident in a company as you might. Their goal is price appreciation of their investment, which is the same as yours. Historical stock multiples are also part of stock analysis and make investing slightly more difficult, as that metrics is somewhat subjective and can be compared to historical ranges of that particular metrics. The multiple is a number that is used when the stock price is divided by the earnings per share. Very aggressive growth stocks usually carry high multiples, while established corporations that have steady earnings generally carry lower multiples. The bottom-up investment approach provides investors with the opportunity to become familiar with the long-term potential of individual companies. Through researching and comparing individual companies, certain investors may be more confident in gains that can be made by investing substantially in a handful of solid companies rather than a broad mix of mutual funds. The downside to bottoms-up investing is the amount of time that it takes to research and analyze the workings of individual companies. Bottom-up investing was made famous by Graham and Dodd and continues to garner fame with the success of Warren Buffett.